Hi guys, Nrupen here, and in this video I will give you some basics about stock market. Now for most beginners the very first question is what actually a stock is. But it is not really that hard to understand. A share is ownership of business represented in parts. For example, consider a businessman needs $200 to start a business, but rather than asking bank for startup money, he goes to 100 investors, tells them about his business plans, and asks $2 each, against which he promises 1% ownership of his business along with all future profits. Here, the $2 contributed by each investor will be considered as one share. In short, share is nothing but ownership of business represented in parts. When ownership of business is represented in capital raised, it is known as equity. So when you buy 5 $2 stocks, you contributed $10 in equity. Similarly, stocks also represent ownership of business represented in percentage. In short, they all mean one and the same thing. The difference is share means representation of ownership in parts, equity means representation of ownership in capital raised, and stock means representation of ownership in percentage. While usage all three mean one and the same thing, for time you are not looking at financial data of business, only those times meaning has to be taken as defined. Now the reason I am creating this video is that there are a lot of people who have created videos on stock market for beginners, and in these videos they have presented you with a lot of misconceptions. The kind of misconception that is not good for beginners. And problem is a lot of people are also sharing these videos and spreading the presented misinformation. The fact is there are a lot of people who have suffered losses in stock market, due to which they compare stock market to gambling, and others who have also suffered losses are sharing it on social media. In short, stocks or shares only represent ownership of business, and stock market is place where you buy and sell ownership of different businesses. Logically, stock market is not really a lot different from a vegetable market. You buy vegetables from vegetable market. Similarly, you buy stocks from stock market. Before you buy vegetables, you make sure to take a look on what are market prices of different vegetables. Then you select vegetables that suit best to your pocket and your quality standard. Similarly, in stock market, you have a lot of options to select from. From all options available, you have to select what's best for you. You buy good quality vegetables because they will keep you healthy and alive to see next day. Same can't be said if you will cook bad quality food. Similarly, while buying stocks, if you will buy stocks that are of high quality, you will reap excellent profit and you will suffer losses due to bad quality stocks. For finding good stocks, you have to spend a good amount of your brain power. Good stocks can make you rich. Similarly, bad stocks can make you poor. Therefore, it is important for you to analyze business before you buy its stocks. We analyze business with help of fundamental analysis and technical analysis. For fundamental analysis, we work on a base concept of what can be a strong business, and then we try to figure out what can be financial traits of this particular strong business. Benjamin Graham used to believe a strong business earns a lot more than what it requires to stay in business. He would spend time calculating intrinsic value of business to find which stock matches his strong business criteria. When stock price of strong business would be less than its intrinsic value, he would invest in that business. Similarly, Peter Lynch believed a business whose products are gaining popularity among customers is strong business. When he would find out about popularity gaining product, he would analyze financial data of business to understand can the business match the ever-growing market demand due to popularity. Similarly, William O'Neill believed a strong business should step in market with such expansion plans that it should scare its competitors. Bill Miller would like to invest in business with growth prospects. Therefore, whenever we say that we are analyzing stocks fundamentally, all we are doing is matching a strong business to its financial traits. Depending on business, success traits for each business can vary a lot. For some it can be intrinsic value, for some it can be moat value, order book, product popularity, joint ventures, foreign endeavors, growth prospects, and even expansion plans. When I analyze stocks, I look for businesses that are ready to enter their economic cycle. Then I try to find out how much these stocks are capable of completing each stage of its economic cycle. If you would like to learn how I fundamentally analyze stocks, then I have a course on Udemy where I teach how I analyze business based on its economic cycle. But the point here to note that is there cannot be one definitive method to analyze stocks fundamentally. Depending on business, the analysis method varies. So when you look for videos on name of fundamental analysis and the person in video tells you to look for low dates, tells you high dates are bad, P should be low kind of stuff, then most likely that person is doing nothing more than reading lines from The Intelligent Investor by Benjamin Graham. But point here to note is that The Intelligent Investor ain't a beginner level guide. To understand The Intelligent Investor in single reading, you must be able to understand business, accounting, finance, and how a debt instrument market works. In short, to understand The Intelligent Investor, you must actually fulfill the criteria of being intelligent. In case you are not intelligent to understand The Intelligent Investor, then most likely you will end up misinterpreting most of the concepts explained by Benjamin Graham. Majority of videos about fundamental analysis on YouTube are spreading misinformation on name of Benjamin Graham. These videos have practically served you shit on name of Benjamin Graham. When you will read his book yourself, you will understand it's not as easy as said and done, because it ain't written for an uninformed reader. Second method via which we analyze stocks is known as technical analysis. Now there are many who have lot of misconceptions about technical analysis. Many think that all they have to do is add some indicators and instant profits, which by no means is ever going to happen. Then they start to complain technical analysis is fraud and it doesn't work. In most accurate terms, technical analysis is calculation of approximation on price chart. Approximation is calculated with help of applied calculus, predictive probability, and mathematical risk calculation. Whenever you will pick any book on technical analysis, you will notice first there are basic chapters on discounting nature of market trends. Then there is nature of price, in which Dow theory is most popularly explained. Some authors might also provide extra theories which may include price cycle theory, Elliott wave theory, market cycle theory, economic cycle theory, and crowd psychology theory. Then we have support and resistance. All indicators and tools are explained after this. And the reason behind this is that these concepts, discounting nature of market trend, nature of price, and support resistance, form base of technical analysis. Indicators and tools are there to support these concepts and not to replace them. When I apply technical analysis, I use price cycle theory as my base concept. Therefore, in my analysis video, you hear me saying price cycle several times. Similarly, the person who uses Elliott wave theory, you will hear him say price waves several times. If you want to learn how I apply technical analysis, then I have a video course on Udemy in which I teach technical analysis based on price cycle theory. The course have two parts. First is video course and second is 21-day practice. Almost everyone who have completed practice associated with course have rated it 5 out of 5. It has been launched just 4 months ago and is one of the top rated technical analysis course on Udemy. Discounted links to it are provided in description of this video for interested viewers. Remember, investing and trading are experience based subjects, which means you cannot learn them just by reading about them. You have to try them, make mistakes, and then try to figure out how, as per your investing knowledge, what went wrong. And to think that you will be able to predict everything with pinpoint accuracy is point blank stupid. Sometimes even after years of experience in market, there may come time where you might have to admit you either failed to understand or made mistake. Expecting absolute perfection is plain stupid. Your job in stock market is not to be right all the time. It's making a lot of profit when right and avoiding losses when wrong. And unless your investments and trades follow strategy to make profits and avoid losses, you cannot expect profits. Just take two things from this video about stock market. Do not blindly trust any video uploaded on internet on fundamental or technical analysis, because there is no one definitive method to apply them. Second, take proper education and don't look for cheap tricks, because if cheap tricks would be working, then don't you think everyone who would have tried these cheap tricks would be rich? Trading and investing can help you make decent profits and even help you make full-time income, but to be a badass investor or trader, you need that level of experience, or you must be born that smart. With that said, thanks for watching this video and have a nice day.